In this video, we're diving deep into the world of candlestick patterns, powerful tools that can reveal market trends, reversals, and continuations at a glance. From single candlestick patterns like the hammer and doji to common multi-candlestick formations like engulfing and morning star, we'll break down each one step by step. Stick around to elevate your trading game with this essential knowledge. Remember to bring your notebook and take note to memorize it perfectly. Introduction. Candlestick patterns are a cornerstone of technical analysis, helping traders predict market movements and identify potential reversals or continuations in trends. In this video, we'll explore two major categories of candlestick patterns: single candlestick patterns and common candlestick patterns. By the end, you'll have a clearer understanding of how to use these formations to make informed trading decisions. Single candlestick patterns. Single candlestick patterns consist of one candle and are easy to identify. Despite their simplicity, they provide powerful signals about potential market movements. Hammer, bullish reversal. The hammer is a bullish reversal pattern that typically appears after a downtrend. It has a small body at the top and a long lower shadow, at least twice the size of the body, with little to no upper shadow. This pattern signals that sellers dominated early in the session, but buyers regained control, potentially reversing the trend upward. Inverted hammer, bullish reversal. The inverted hammer also appears at the end of a downtrend, but has a small body at the bottom and a long upper shadow. This indicates that buyers attempted to push the price higher, showing potential strength, even if the session closed near the open price. It often requires confirmation from the next candle to validate the reversal. Shooting star, bearish reversal. The shooting star is a bearish reversal pattern that forms after an uptrend. It has a small body at the bottom and a long upper shadow resembling an inverted hammer. This indicates that buyers pushed prices higher, but sellers regained control, often leading to a downward trend. Hanging man, bearish reversal. The hanging man forms at the top of an uptrend and looks identical to the hammer, but signals bearish reversal. It has a small body at the top and a long lower shadow, indicating that selling pressure is increasing. Like the shooting star, confirmation is needed from subsequent candles. Marubozu, continuation. A marubozu is a candlestick with no wicks, meaning the price opened at one extreme and closed at the other. A bullish marubozu indicates strong upward momentum, while a bearish marubozu shows powerful downward momentum. It often signals the continuation of the current trend. Doji, indecision. A doji has a very small body, indicating that the open and close prices are nearly the same, with long wicks on both sides. This pattern signals indecision in the market, often appearing before major trend reversals or breakouts. Variants like the gravestone doji or dragonfly doji add nuance to this signal. Common candlestick patterns. These patterns involve multiple candles and provide more complex signals about the market's direction. Engulfing patterns, bullish and bearish reversals. Bullish engulfing. A smaller bearish candle is completely engulfed by a larger bullish candle, signaling a strong reversal upward. Bearish engulfing. A smaller bullish candle is engulfed by a larger bearish candle, indicating downward momentum. Harami patterns, bullish and bearish reversals. Bullish harami. A small bullish candle forms within the body of a preceding bearish candle, signaling a potential reversal upward. Bearish harami. A small bearish candle forms within the body of a larger bullish candle, suggesting a potential downward reversal. Morning star and evening star, bullish and bearish reversals. Morning star. A three-candle pattern starting with a bearish candle followed by a small-bodied candle, often a doji, and ending with a strong bullish candle. This signals a shift from bearish to bullish sentiment. Evening star. The bearish counterpart of morning star, signaling a reversal from bullish to bearish. Dark cloud cover, bearish reversal. This pattern consists of a long bullish candle followed by a bearish candle that opens with a gap up but closes below the midpoint of the bullish candle. It suggests strong selling pressure and a potential trend reversal. Piercing line, bullish reversal. The piercing line is the bullish counterpart of dark cloud cover. A long bearish candle is followed by a bullish candle that opens below the previous close but closes above the midpoint of the bearish candle, signaling potential upward momentum. 3 white soldiers, bullish continuation. This pattern involves 3 consecutive long bullish candles with small wicks, indicating strong buying pressure and the continuation of an uptrend. 3 black crows, bearish continuation. The opposite of 3 white soldiers, this pattern consists of 3 consecutive bearish candles with small wicks, signaling strong selling pressure and the continuation of a downtrend. Conclusion: mastering candlestick patterns is a vital skill for traders, providing insights into market psychology and potential price movements. Whether it's a single candlestick like the hammer or a complex pattern like the morning star, these tools enable you to anticipate reversals, continuations, or consolidations. Use them in combination with other technical indicators for the best results. Understanding candlestick patterns is like learning the language of the market. Once you master it, you gain a clearer view of where prices might be headed. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you don't miss more trading insights. Thanks for watching, and happy trading!